फोटो नहीं है.
Yeah. A very good evening to everybody. I am CA Rahul Parikh, Regional Council Member. I welcome you all to today's session on our ongoing series on accounting standards, intensive refresher course on practical aspects of accounting standards. So today we are dealing with something which is likely to has a very important aspect. These are all standards which directly have an impact on the profitability and the financial statements, and so we will be dealing with standards such as AS 15 and all other standards which have a measurement impact on our financials. So, and I think we have I would welcome CA Akshay Oke, our faculty for today's session. Welcome, Akshay bhai. And
thank you, sir.
I'll just take this moment to formally introduce Akshay bhai. So see, Akshay Oke is a partner with FinPro Consulting. He is CEO and he's also CEO and Managing Director of Liaison Private Limited. He's a chartered accountant, masters in commerce, and also holds a diploma in IFRS at ACC UK. Akshay bhai has more than 12 years of experience in Ind AS, IFRS, accounting standards, financial reporting, and he has been associated with Big Four consulting firms for more than 5 years, and he specializes in providing technical accounting background on IFRS, US GAAP implementation services to various leading organizations, and is a regular speaker on this AS, Ind AS, IFRS. He has trained more than 3,000 students in ACCA diploma in IFRS. That's indeed impressive. So with these few words, I welcome Akshay bhai to today's session. Thank you, Akshay bhai, for accepting our invitation and taking up this session. Friends, I think, see, while accounting standards have been there for a very, very long time, for some reason, possibly our profession today, we discuss a lot on Ind AS and IFRS, etc. But somehow we lose sight of the fact that AS actually are the standards which are applicable to almost 75% of the organizations where we are doing audit, and especially possibly even the non-corporate assets where these become applicable, the level of implementation of AS is very, very low. So, and with these things in mind, we had actually designed this course that we need to create more awareness of AS and proper implementation of AS in all this in all private or rather unlisted entities or non-public interest entities where actually these accounting standards are to be implemented. So I hope everybody has a very enriching experience today. Akshay bhai, I now pass on the baton to you. You may kindly take charge of this. So thank you.
Yeah, thank you. Yeah, thank you so much for the introduction. And I thank WIRC of ICI for inviting me for conducting this session on accounting standards. It's my privilege to be associated with WIRC. So friends, today we are going to speak on 4 accounting standards. We will start with little bit more complex ones with AS 15 employee benefits. Then we will move on to accounting for taxes on income, which is AS 22. Then we will go to AS 11, the effects of changes in foreign exchange rates, and lastly AS 28, impairment of assets. So in all these 4 standards, I'll try to bring out a lot of practical case studies and examples which we have actually worked while implementing these accounting standards or Ind AS in various companies. I'll try to mix some of the concepts and examples. So first we will have a better clarity of what these accounting standards say, and then we will have a case study around that particular concepts. So that is going to be the modus operandi. We will start with AS 15 employee benefits first, which most of the participants, or when I was studying my chartered accountant course, faced that okay, this could be a little bit of challenging standard to understand, to interpret, and actually implement in practice. So today I will try to decipher this particular AS 15 standard more from a practical angle, and we will all study basically how this actuarial valuation report has to be kind of deciphered and accounted as per AS 15. So that is going to be the main objective of today's session on AS 15. So as we all know that employee benefits are primarily converted or divided into four kind of categories. One is short-term employee benefits, which comprises of your salaries, wages, any short-term benefits in the form of bonuses, etc. Then we have post-employment benefits, which are the benefits which are payable after your employment, typically the gratuity, or it could be pension benefits, your provident fund benefits, etc. Then the third category is called as other long-term employee benefits, which is generally paid during the course of your employment, but they are settled or paid after 12 months from the reporting date. Typically, it could be leave encashment, or it could be bonuses which are paid after staying in 5 years of organization. So these all could be the benefits in other long-term employee benefits. And lastly, we have termination benefits, which is nothing but the benefits which are paid on termination. That is either when the employer terminates the services of an employee, or employee selects the voluntary kind of a redundancy plan or voluntary retirement scheme as declared by the entity. So these are the four main primary categories of employee benefits that we are going to discuss. There is one more category of employee benefit which is called as share-based payment, or popularly known as ESOPs. However, ESOPs are not covered by AS 15 employee benefits. Under Indian GAAP, we have a separate guidance note which is issued by Institute of Chartered Accountants of India for accounting of your share-based payments. We also have coming up with a new standard on the share-based payments pretty soon. Currently, it is in the draft stage. So with this background, we will study this AS 15 employee benefits more in detail. Firstly, we will go to the more complex part of AS 15, which is post-employment benefit plans. So we all know that for this gratuity, for your leave encashment, we have to obtain actuarial valuation report, and then we have to account for using this actuarial valuation report. But friends, I'm sure many of us have actually not gone through the detailed actuarial valuation report. What does that actuarial valuation report mean? How do I read the content which is written in the actuarial valuation report? What are the different meanings of the different terms like current service cost, interest cost, contributions, benefit paid? There are so many n number of terms which are used in the actuarial valuation report. So today we have an opportunity to understand what those terms really mean and how to practically apply those terms while accounting the post-employment benefits under AS 15 employee benefits. So that is going to be the key learning session with respect to AS 15 today. So primarily, the post-employment benefit plans are categorized into two parts. One is called as defined contribution plan, and second is called as a defined benefit plan. So defined contribution plan says that it is an obligation. That means the employer is liable to pay the contribution to a specific fund. And once that amount is paid to that particular fund, the entity or the employer does not have any further legal or any constructive obligation to pay any additional amount to the fund. So in case there is shortfall in that particular fund in order to pay the employees, the employer is not further obligated to pay any amount. So the entire risk of investment and actuarial risk is with that particular fund. So to give you an example, the typical example of defined contribution plan is basically the provident fund. So what happens in case of provident fund is the employer deducts whatever 12% of basic salary as employer contribution as well as employee contribution and pays it to generally a government approved provident fund. And when employee retires from the organization or he leaves the organization, that employee has an option to basically withdraw that particular fund. Now, whatever is the interest accrued on that particular fund or whatever the changes, the employer is no longer concerned as long he's paying the monthly contributions into that fund. So the entire risk of making investments lies with that particular fund. And that is why in most of the circumstances, we would say that the contribution to our provident fund is a defined contribution plan. The second is a defined benefit plan. So in a what you can call as a, there is no standard definition of a defined benefit plan. It says those plans which are not defined contribution plan are defined benefit plans. So in this particular plan, the employer continues to have a legal or constructive obligation to pay to an employee if there are any shortfalls in the fund. So I'll explain you with an example. Generally, the gratuity or if pension is applicable falls under this category. Now, we all know how the gratuity is computed. So once the employee is there in the organization for 5 years, the employer is bound to pay the gratuity when he retires or leaves from the organization, which is, there is a set standard formula like 15/26 into last month salary drawn into number of years completed. So that is the amount that the employer has to pay to the employee at the end of this service tenure. So what happens is, even if the employer makes some contributions to a trust or any insurer for that matter, so you must have seen in your clients or in your companies that the companies periodically fund some amount in order to make that fund available for the payment of gratuity. In that case, generally that is known as a funded plan. So the employer has enough cash or funds available to pay to the employee when he or she retires from the organization. Now, in case there is any shortfall in the fund, even after taking due care, risk, and investments, it is a duty, it is a responsibility of an employer to make good that shortfall. That trust or fund does not take that particular investment risk or actuarial risk. So in case there is any shortfall in the fund, the employer has to make good that shortfall, and hence it is known as a defined benefit plan. So basically the key difference between defined contribution and defined benefit is, in case of defined contribution, the obligation is not with an employer in case there is any shortfall. In case of defined benefit, the obligation stays with the employer. Now, I'll just share my experience from my practical application of what is defined benefit and defined contribution, because the accounting is completely different for defined contribution plan and defined benefit plan. Now, a lot of chartered accountants or finance professionals are under the impression that defined contribution plan is always a provident fund and gratuity is already a defined benefit plan, but that's not the case. So I'll give you an example. In one of our clients, the company itself had set up a trust on its own. So ABC Limited was the company name and ABC was the trust. So that ABC company was deducting, let's say 12% of the basic salary from the employee's basic salary, and it was contributing to that trust. And then trust was making investments in corporate bonds, in government bonds, etc. And that trust was basically paying to the employee the whatever is a provident fund at the end of the service tenure. Now, we need to check who has set up the trust. It is the company who has set up the trust. So it is a related party of that particular company. So what happens is, if the trust does not have funds at the end of the day to pay to that employee, the responsibility of paying that shortfall falls back with the company, because it is a trust which is formed by the company itself. In this particular scenario, this contribution to provident fund will not be considered as a defined contribution plan, but it will be considered as a defined benefit plan. But in case you're making contributions to a government trust or a government provident fund, then the employer is no longer required to make any good the shortfall in case there is in a fund. So that is where a defined that is where the provident fund becomes a defined contribution plan. So when you do audit of your employer or audit of any company, we just need to check whether a defined or whether the provident fund is with the trust which is set up by the company, or it is completely to a third party where the company is no longer concerned. And that is how you make the classification whether it is a defined contribution plan or defined benefit plan. Now, defined contribution plan, the accounting is pretty simple and straightforward. It is just like accounting for any other short-term employee benefit. So whatever contributions that you are making to the trust on a monthly basis, that amount is accrued as and when the service is rendered. That accrual amount is recognized as an expenditure in your statement of profit and loss over the period of the service life. In case you have paid any advance amount, it will be considered as an asset. In case there is any shortfall on the amount paid, it will be considered as a liability. So it is just as simple as recognizing any other normal expenditure in the statement of profit and loss. There is only one disclosure. Whatever is the total contribution that you are making to that particular fund, you need to disclose it as a part of the notes to the financial statements. So there is no fancy accounting for defined contribution plan, pretty straightforward accounting. The more important is a defined benefit plan, and we will try to understand and decipher the various terminologies and words which are used in actual evaluation, how to interpret them, and how to account for it in the financial statements. So the accounting for defined benefit plan may become complex because of several assumptions which are used by the actuary, and there are several estimates that one needs to make while arriving at the total liability relating to the defined benefit plan. Now, as you all know that let's take an example of gratuity. So generally gratuity is computed as 15 by 26 into last drawn salary into number of years of completion of that particular employee. Now, if you see in that particular formula, only 15 by 26 is the constant. We don't know what could be the last drawn salary. We don't know how many number of years a particular employee is going to work in that organization. And that is why, in order to estimate the total outflow at the end of his retirement life, we need to use certain assumptions or estimates while calculating the total liability relating to gratuity or any other defined benefit plan. So the first one is called as demographic assumptions, which are mainly based on past experience, which could be mortality rate, your employee turnover, which is nothing but an attrition rate, the disability, or the cases of early retirement. So all these assumptions are generally made by the actuary. Only, of course, the rate of employee turnover, which is an attrition rate, has to be given by the company. So first are the demographic assumptions. And second are the financial assumptions, which are based on the market expectations. So it could be discount rate. Now, why discount rate is used? So we all know that this amount of gratuity or any other defined benefit has to be paid when the employee retires from the organization or he resigns from the organization. So that is generally 2 years, 3 years, 4 years, 5 years, 10 years down the line. So the standard says the value of any amount which is payable in the future is not the same value, and hence you need to discount it to the present value. So we need to assume certain discount rate to bring it to the today's value. Then expected rate of return on planned assets. So as we discussed earlier, a lot of prudent companies kind of already make a provision in a separate trust or with LIC or any other insurer. They keep on investing a particular amount on a yearly basis. So they have sufficient balance to pay the gratuity amount or any other defined benefit amount. So if you are a funded plan, a funded defined benefit plan, then again you need to estimate what could be the approximate return that you'll be achieving on these particular funds which are invested with an insurer, LIC or any other company. So that is again an assumption. And of course the future salary and benefit levels and the promotion factors, etc. So basically in a layman's language we also call it as a expected salary escalation rate. So all these assumptions are typically used while calculating the liability under the defined benefit plan. And since this is an actuarial science, for calculating the estimated liability under the defined benefit plan, we go to the actuary for the calculation part, who is a qualified person to carry out such activities. And hence these assumptions, these demographic assumptions as well as financial assumptions are commonly referred to as actuarial assumptions. Going forward, so what is recognized in the balance sheet? So in balance sheet, we only recognize the net defined benefit liability, or it could be asset in a very remote circumstances, which is nothing but the liability relating to the payment of obligation under defined benefit plan. In a layman's language, we can say gratuity provision in a very simple language, minus the fair value of the plan assets. So that is nothing but whatever amount that you have invested with a particular fund, trust or any insurer, what is the fair value that needs to be deducted while calculating the net defined benefit liability. And lastly, the effect of asset ceiling. So what is asset ceiling? If your assets are greater than the liability, then that additional asset part you can recognize only to the extent you will be receiving a refund in the future period, or you can make the lower contributions in the future period. So that asset ceiling test has to be met in order to recognize the net defined benefit liability. So in a very simple language, the total liability as determined by the actuary relating to the defined benefit plan, let's take an example of gratuity, minus the total value or fair value of the plan assets which is invested with a particular insurer or any other trust or any other fund subject to the asset ceiling. That is what is recognized in the balance sheet. So what is an actuarial technique that we are talking about? So the actuarial technique which is used for the calculation of this defined benefit obligation or liability is called as a projected unit credit method, which is nothing but it is an estimate of the total gratuity which is payable by the organization or an entity, which is discounted using the market yield on government bond rate. So this is the discounting factor that we are going to use while actually discounting this gratuity amount or any other defined benefit obligation. So generally we have to go to the actuary, to the qualified actuary for doing this particular calculation. Now the $1,000,000 question is, what is the discounted market yield on government bonds? So we know that there are a lot of government bonds. So which rate or which government bond we need to refer while calculating the discount rate? So this is a practical application of the accounting standard. Now, when we actually implement this in practice, what we do is we check the two factors. The first factor is the currency in which the underlying liability has to be paid. So in 99.99% cases, it will be under Indian rupees. So that government bond rate should be denominated in Indian rupees. That is the first criteria. And the second criteria is, what is the tenure of that government bond? So there are, if you see, there are several tenures, 1 year, 3 year, 5 year, 10 years, etc. So which government bond of which tenure should I consider while determination of a discount rate? So the practical application says that you need to consider the average remaining service life of that employees of that particular organization. Mark my words, it is average remaining service life, not the total life. Average remaining service life of the employees in that particular company or organization. So let's say 10 years is my service life, remaining service life of that particular employees of that organization. Then generally I will consider that bond which will have a tenure of 10 years as an expiry. So I need to consider two factors. One is the underlying currency in which the liability is going to settle. And second is the average remaining service life to choose the discount rate of any particular government bond rate. So this is how the actual discount rate is used, because discount rate plays a very crucial role in determining what will be the impact on your profit and loss. And this is one of the key factors that impacts my profitability using of discount rate. So you need to be very 100% sure while selecting the government bond rate. So I'll give you a very interesting story here with respect to discount rate that I had faced in one of my clients. So my client was under Indian GAAP basically, a local manufacturing company of about size of 100 crores, and it had basically a German subsidiary. So German subsidiary was preparing accounts under its local GAAP, which is more or less similar to IFRS. And in IFRS, everybody knows that instead of government bond rate, we use a corporate bond rate. So that is the difference between Indian GAAP and IFRS. So the government bond rate in Germany was probably around 3 to 4%, or more than that, little bit, 4 to 5%. And that is where the that was the rate which was used for calculating this defined benefit liability or gratuity liability for the German employees. So just mark my words, it was around 4 to 5%. When this German company was getting consolidated under the Indian parent. Now we all know that while we prepare the consolidated financial statements, we need to use the uniform accounting policies of the parent company and the subsidiary company. So while calculating the liability of a defined benefit plan of a German subsidiary under Indian GAAP, we had to use the government bond rate as applicable in Germany for that particular company. So the government bond rate was much lower as compared to the corporate bond rate. It was around 0.5% to around 1%, something sort of that. Now, because of the lower reduction in the rate from 5% to 1%, there was an enormous increase in the liability relating to the German subsidiary company. And because of the increase in the liability, there was an additional expenditure that hit my consolidated profit and loss. And it was around 35 to 40 crores of additional expenditure because German company was a material company. So just because of changing the rate from government bond rate to corporate bond rate, there was an additional hit on my P&L in the consolidated financial statements of this Indian parent entity. And that is what it can create an impact of choosing the right rate. And during that time, the Indian company was seeking a funding and it could not really take the hit of that 35-40 crores in the P&L in the consolidated financial statements. So that is where, as a consultant, we had to apply our mind. And we told the company that what you can do is you can really adopt voluntarily Ind AS, because under Ind AS there is an accounting policy choice to continue with the corporate bond rate in case your subsidiary is residing outside India. So the Indian company applied Ind AS on a voluntary basis. They went with a government bond rate which is allowed as per Ind AS. For their foreign company, they continued with the corporate bond rate which is also allowed under Ind AS. And that is how we could save a P&L negative impact of almost 35 to 40 crores. And the company could easily go for the funding. And that is a very important point to know your accounting standards very well. Some consultants, auditors, CAs think that it is just a mere compliance. But through this innovative technique of thinking, you could save a lot of funds, or it could facilitate funding or any other aspects relating to the company. So the small and minor points are very important while you study these accounting standards. So going forward to our next slide, we will now discuss what is really meant by the wordings, by the different statements, by the different terminologies which are used in actuarial valuation report. So you have seen there are a lot of tables in the actuarial valuation report. It starts with your opening liability or net defined benefit liability. Then there are amounts recognized in the balance sheet. Then there are amounts recognized in statement of profit and loss. In case you are applying Ind AS, there are amounts recognized in OCI. So a lot of different tables are stated in the actuarial valuation report. What are the different actuarial assumptions which are used? What will happen if there are changes in the actuarial assumptions? So all these tables are stated if you open any actuarial valuation report. So generally it starts with the opening balance of your net liability. Then comes the service cost and the interest expense or expected rate of return on plan assets, which is generally recognized in the statement of profit and loss as a part of your total employee benefit expenditure. Now, what does this service cost means? What this interest expense means? So service cost is nothing but it is an additional cost with respect to any defined benefit obligation, let's say gratuity, when an employee provides additional year of service to the organization. So effectively, let's say today I have completed 7 years in the organization. Let's assume that. So the formula is 15/26 into my last month's salary into 7 years. This is the total value that I have to pay right now. But last year I have paid 15/26 into last month's salary drawn into number of years completed, 6 years. So the differential amount, which is an increase on account of the additional year of service which is provided by the employee to the organization at a discounted value, is nothing but the service cost. So increase in gratuity amount at the discounted price when the employee provides additional year of service to the organization. It is as simple as that. That is called as the service cost. So that is straight away taken to my statement of profit and loss. Then second component which goes is interest expense, net minus expected rate of return on plan assets in case the company has a funded plan. If it is unfunded plan, then we do not have any assets as such. So what is interest expense? So interest expense is nothing but it is an unwinding of my liability relating to the defined benefit plan. So let's say your total liability is 100, the discounted value comes to 70 rupees and my bond rate is 10%. So that additional 10% on 7 rupees on 70 rupees, which is nothing but 7 rupees, is nothing but an interest cost. So the interest percentage into my opening liability is called as the interest expenditure, which again goes to my statement of profit and loss. Some companies show it as a part of employee benefit. Some companies show as a part of finance cost. Both presentations are acceptable. Net of expected rate of return on plan assets. So as we know that the excess money that we have, we kind of invest in trust fund or insurer, LIC, any other company. So what is my expected rate of return on that plan assets? So it could be with respect to interest, it could be respect with dividend or any capital gains in case there is a churning of the portfolio. So you need to assume or estimate the total expected return on these actual plan assets and deduct from the interest expenditure and present the net amount in your statement of profit and loss. So service cost will increase the liability. If it is net interest expenditure, again it will increase your liability for the current period. Now third is actuarial gain and loss. Now what do you really mean by actuarial gain and loss? We have all heard of this term before, actuarial gain and loss. So actuarial gain or loss is caused because of two circumstances. First is it is a difference between the estimated liability and the actual liability. So I'll give an example to explain. So let's say while actually estimating the total liability, the company had considered a salary escalation rate of 10%. Year on year, the salary of an employee would increase by 10% on an average basis. However, let's say after 3 years, the employee retires from the organization. His salary increase year on year only to the extent of, let's say, 7%, not the 10%. So naturally, the employer paid less benefit as compared to original estimated benefit. So earlier we were presuming that the gratuity will be based on a salary which is escalating at 10%. However, when you actually made the payment, the salary was to the mark to the extent of only 7% escalation. So naturally, I had recognized more liability and I paid less amount when the employee retired from the organization, which resulted into gain to the organization because naturally I paid the less amount of gratuity amount. That gain of 3%, not exactly 3%, but I'm just giving you an example. Let's say the 3% gain which the company is recognizing, that is known as an actuarial gain because it was coming from the different assumptions which were made by the actuary against the actual outcome when the employee retired from the organization. That is the first what you can say instance where an actuarial gain and loss could occur. Now the second instance where actuarial gain and loss could occur is by revising the actuarial assumptions. So it is not estimated versus actual, it is estimate versus revised estimate. So let's say now actuary says, okay, I had considered 10% as a salary escalation rate. Lot of employees retired only with a 7% salary escalation rate. So I will change my estimate based on what is company saying. So he says now I'll bring down the salary escalation rate from 10% to let's say 5%. Because of COVID, there is a less increase in the salary. So now no one has retired from the organization or left the organization, but the actuary is revising its original estimate of 10% to 5%, which has resulted into a lower liability as compared to the original opening liability. So obviously, naturally, when the liability is reduced, there will be a gain which will be recorded in your statement of profit and loss. So again, that gain is nothing but it is called as a actuarial gain. So if it is a vice versa situation, it will be an actuarial loss. So either the actual versus estimated or estimated versus revised estimated could cause a gain or a loss, and depending on that, your liability will increase or decrease. So again, that goes to my P&L. Under Ind AS, this actual gain and loss goes to my OCI. Then we have benefit payments. Benefit payment is basically nothing but the amount of gratuity or any other defined benefit amount that is directly paid to the employee. Now, benefit payments could not basically may not have any significant impact on the balance sheet because you will reduce the asset, you will withdraw from your fund and pay to the employee. So naturally there will be a reduction in the asset because you are withdrawing it from the fund and you are paying it to the employee. So when you pay to the employee, the liability would also reduce to that extent. So when you pay the amount to the employee by withdrawing that amount from the fund, it does not have any impact as such on the balance sheet because there is a reduction in the asset as well as there is a reduction in the liability. Then we have contributions. So contribution is nothing but the total amount which is contributed by the employer towards a specific fund is called as a contribution, which results into increase in your funding or increase in your defined benefit plan asset, or it could be reduction in your net liability. So the effect is same, reduction in the net liability or increase in the asset. So no impact on your P&L. This constitutes my net defined benefit liability or asset at the end of your reporting period. Any very remote circumstances where you could have curtailments or settlements, in case there is a transfer of division or a closure of division, there could be a very remote circumstance where the existing liability needs to be paid off immediately, or there is an additional liability on account of curtailment, that is lowering down of operation and payment of one-time benefit to an employee, or there is a settlement amongst the employees for which one-time adjustment is required. So all that amount goes to your statement of profit and loss. So just a quick recap: service cost will increase your liability because that is an additional cost. A net interest expense will increase the again liability. If it is net rate of return on plan asset, then it will decrease the liability. Actuarial gain on loss, depending on whether it is gain or loss, will cause the movement. Curtailment settlement again will cause increase in the liability. Benefit payments will generally not have impact on the balance sheet as long as there's a withdrawal from the fund and payment to your employee. And contributions will increase your plan asset, or it will decrease the net defined benefit liability. And it will result into your closing defined benefit liability, which will be ultimately recognized in your balance sheet. So these are the various terms which are used in actuarial valuation report. If you open any report, now you will be able to understand the meaning of these various terms and how those are accounted as a part of my financial statements. So this is what we discussed. Service cost goes to my P&L. Each year employee provides a service which will result into additional benefit. You calculate at present value using the actuarial technique, which is the projected unit credit method. Then in the service cost, we also have one more concept which is called as a past service cost. Now, what is a past service cost? I'll give you an example. Have a case study. So let us say employee receives pension, which is 1% of the final salary of each year. And now there is a change in the calculation formula. In year 3, employee increases the rate retrospectively from 1% to 2%. So earlier employer was paying 1% of your salary as a pension cost for each of the years of service completed. Now retrospectively, the employer has increased the benefit from 1% to 2%. So in year 1, the employer was paying 1%. You can see here 1%. Then in year 2, the cumulative pension is 1% with respect to first year and another 1% with respect to second year. So the total cumulative benefit was 2% of the total salary. In year 3, there is a change in the formula. So 1% relating to the first year, again 1% relating to the second year. Now you have revised in the third year, which is 2%. So this 2% is relating to the third year. And now whatever is the additional benefit, 1% of year 1, the differential amount, and 1% of year 2, again the differential amount. So this actual additional expenditure that we are recognizing because of the change in formula from 1% to 2% is called as a past service cost, because this is an additional expenditure which is relating to the services provided by the employee in the previous years, and that is why it is known as a past service cost. Now under Indian GAAP, this past service cost is recognized in P&L only to the extent of wasted benefits. Now what do you mean by wasted benefits? Now as we all know that gratuity, for example, you need to be eligible in or you need to complete 5 years in the organization, approximate 5 years, in order to become eligible for gratuity. Now let's say there is a total 100 rupees which is a past service cost, out of which let's say 80 rupees is relating to the employees who have already completed 5 years. That means that 80 rupees is wasted. The employee is due to get that amount at any point in time when he leaves the organization. So if he is eligible for the past service cost, then we call it as a wasted benefit. That benefit has already wasted with a particular employee. So that
क्या हुआ सर? हेलो, हाँ भाई, हाँ हेलो सर, माइक म्यूट है आपका सर, आपका नेटवर्क शायद इशू है, माइक म्यूट है सर, आवाज नहीं आ रहा है। कंप्यूटर ऑडियो सिलेक्ट करिए सर। हेलो अटेंडी सर, एक बार आप सब वापस से ज्वाइन करेंगे। टेक्निकल थोड़ा इशू आ गया था सर, तो एक बार वापस से मैं बंद कर रहा हूँ, वापस से ज्वाइन करिए एक बार आप सब जन फिर से।
Hello, can you hear me now?
सर यस सर कंटिन्यू चालू करिए सर।
Sure, sure. Yeah, so I'll just continue with slide number 10 again. Yeah, so I was saying that apart from the current service cost, we also have past service cost. So past service cost is nothing but the benefits which are relating to the prior years is recognized in P&L to the extent of vested benefits. So we had discussed one example relating to the pension. So assuming that employee receives 1% of pension as a final salary for each of the years of the service completed. However, in year 3, the employer changes the percentage from 1% to 2%. So in year 1, we are getting 1%. In year 2, cumulatively, it is 2%. In year 3, this 1% with respect to first year, 1% with respect to second year, 2% with respect to the third year, and this 1% each of year 1 and year 2, because the rate has retrospectively changed, is called as a past service cost. So to the extent of vested benefits with the employee, it will be recognized in P&L. To the extent of unvested benefits, it will be recognized throughout the vesting period. So that past service cost will also be a part of your P&L. The interest and expected rate of return we already discussed. So we will take one example here to understand how this defined benefit plan works. A lump sum benefit is payable on termination of service, which is equal to 1% of the final salary for each year of the service. The salary in year 1 is 1 lakh and it is assumed to increase by 7% year on year. The discount rate which is used is 10%. Therefore, the total salary which is expected to be paid at the end of the 5th year is 1,31,000. And the benefit is 1% of the final salary, so which is 1310. So what we are going to discuss in this case study in our next example is how do we build up that obligation? How do we recognize the current service cost? How do we recognize the interest cost? That is what we are going to discuss in the next slide. So in the first year, we will say that, okay, 1310 was total payable at the end of 5th year relating to the year 1 service. If you discount 1310 at 10% using 5 years rate, it comes to 895. So in the first year, the company will recognize 895 rupees of expenditure as an employee benefit cost and create the liability to the extent of 895. The next year, this closing balance will become opening balance of 895. On that, since we are 1 year closer to the date of payment of the gratuity or any other liability, I will unwind the interest amount to the extent of 10%, which is my discount rate. So 10% of 895 is 90. So 90 is my total cost. Then for the second year, again, I am liable to pay 1310. Now, if you discount it for the remaining tenure, it will come to 984. So the closing balance is opening obligation of 895, interest at the rate of 10%, which is 90, and current service cost, which is 984. So the total obligation is 895 plus 90 plus 984, which is 1969. So this will continue till the end of 5th year. This 1969 will become opening balance. Then again I will charge interest of 10%, which is 197 on 1969. Then current service cost is discounted price or discounted value of this 1310 for the remaining term, which is 1082. So the closing liability is 3248. So this is how I will build up the obligation at the end of 5th year. The opening balance is 4763 at the end at the beginning of the 5th year. The interest rate is 10%, which is 477 on 4763. Now there is no present valuation required because we are at the end of 5th year. So the present value of 1310 is 1310, and finally the closing obligation is 6550. So the company was expected to pay an amount of 6550. Okay, but we will not recognize entire 6550 at the beginning of the 1st year or at the directly at the end of 5th year. So 6550 will be recognized between the current service cost over these 5 years and interest cost over these 4 years. So this is how the actual accounting is also done in real life practice. The only additional points that we will be having is basically the actuarial gains and losses whenever there are changes in the assumptions. So we already discussed that. What do you mean by actuarial gain and losses? It could occur because of the change in the estimates. It could be on change in estimates between the actual return and expected return, or the asset ceiling changes. So this was all about the post-employment benefit plans. For other employee benefit plans, we are going to spend very little time, since it is very easy from an accounting perspective. So short-term employee benefits is nothing but your wages, salaries, any social security contributions, any compensated absences or leave encashment, which is paid within 12 months from the reporting date. All these are short-term benefits. So these are nothing but these are straight away recorded in your statement of profit and loss without any discounting factor. So it is just like recognizing any other expenditure as and when it is accrued. So this is what we discussed. The recognition is criteria is similar to AS 29, undiscounted cost. There are no specific disclosures also. However, any amount which is paid to your key management personnel like director or CEO, MD, chairman, etc. would have to be disclosed separately as a part of your related party disclosure. Now, what do you mean by other long-term employee benefits? As we discussed, that these benefits are paid during your employment, but which is paid beyond 12 months from the reporting period. So it could be leave encashment, which could be carry forward beyond 1 year, or it could be long service awards, like bonus is paid after completion of 5 years in the organization. So all such type of rewards or awards which are paid to employees during the term of the employment are called as other long-term employee benefits. So basically, these are accounted exactly in the same way as we discussed for your post-employment benefit plans. Generally, these plans are not funded plans. The employer does not contribute any specific amount towards the funds. So it is accounted similar to your post-employment benefit plans, except the past service cost related information or the accounting is done immediately in your statement of profit and loss. Now, in the first session, you must have discussed the applicability of various accounting standards. Now, ACE 15, whatever the complexity part that we discussed relating to discounting, actuarial valuation, this and that, is generally not applicable to MSMEs. It is applicable to non-MSME companies, or one would say level 1 companies, which is defined in the accounting standard rules of 2020. And the last one is a termination benefits. So termination benefits are nothing but they are payable either on company's decision to terminate the employee before the termination, before the retirement date, or employee decision to accept the VRS. So in either of the case, you call it as a termination benefit. There is no specific recognition criteria. It is again recognized as and when it is accrued. Yeah, so we were talking about the termination benefits. So the entity will recognize any termination benefits as a liability and expense only when only when the entity has a present obligation as a result of past event, and it is probable that the outflow would be there and amount can be reliably estimated. So there is no stringent criteria. Basically, it is a normal criteria which is applicable to recognition of any other liability. The only additional point here is that the amount will have to be discounted if the amount of termination benefit is payable beyond the period of 12 months. So the main aspect was relating to the post-employment benefits in age 15 employee benefits. For any other accounting, it is pretty much straightforward. So we will discuss some of the case studies or examples again. So ABC has a headcount of 100 employees in 21-22. As per the policies of the company, the employees are entitled for 30 annual leaves, out of which 10 may be carried forward to the next year. 10 sick leaves, out of which 2 may be carried forward as paid leave. As at March 31st, 2022, the average unused entitlement is 5 days per employee for a privileged leave or a casual leave, one may as we call it, and 1 for sick leave. So 5 for privilege, 1 for sick leave. On an average, it is found that number of such employees who would be claiming annual leaves would be 30, and 10 employees who would claim sick leaves. You need to compute the liability to recognize the sick pay and the privilege pay by the entity as at the end of 31st March 22. So it is pretty simple. So there are 30 employees basically. So 30 employees who are entitled at 5 days leave. So this is 150. This is relating to the privilege leave. And then there are 1 sick leave for 10 employees. So this is what you will recognize as a liability. So 150 plus 10 is basically the total liability that would be recognized at the end of 31st March 22. Next step, whether the concession loan provided by an enterprise to its employees is an employee benefit, and how such concession loan should be treated in the financial statements of the company. So very interesting question or a case study here. So we all know that a lot of companies provide interest-free loan or loan at a concessional rate to employees. So it could be vehicle loan or it could be a home loan. Now, Indian GAAP does not have any specific accounting treatment which is prescribed either in AS 15. It was originally recommended or prescribed under AS 30, the financial instrument standard, but no longer it is relevant under Indian GAAP scenario. So basically, what is the benefit that the employee is getting? It is nothing but the underlying interest which is waived off is the actual benefit that the employee is getting. Now, neither AS 15 nor any other accounting standard which is notified prescribes the accounting of the loan which is given to the employee at concessional rate. However, if you have noted that income tax does mention that you need to consider the interest-free component as a perquisite and it has to be taxed under the head salary as a perquisite. However, under Indian GAAP scenario, accounting standard scenario, there is no such provision to record the notional interest or record the notional employee expenditure for which we are providing the additional benefit to the employee. So under Indian GAAP scenario, this additional employee benefit will not be recorded as an expenditure in your P&L. However, if you are under Ind AS or IFRS regime, the Ind AS and IFRS standards do mention the accounting treatment. It says that whatever is the additional benefit in the form of interest-free or loan or a concessional loan, that will have to be accounted as a employee benefit. So the answer is under Indian GAAP, no accounting treatment. Under Ind AS and IFRS, the notional interest that I am not recording will be recorded as an employee benefit. This is also very interesting case 4 or example 4. In case of defined benefit schemes covered under the group gratuity or other defined benefit schemes, where the actuarial risk and investment risk have not been transferred from the enterprise, whether an enterprise can rely upon the actuarial valuation certificate provided by the insurance company or a separate certificate from a qualified actuary is required to be obtained for determination of actuarial liability. So what is the scenario? Basically, I have given the fund to a insurance company under the defined benefit scheme, and the risk is transferred to that particular company. Now, whether the valuation which is provided by that insurance company is sufficient, or you need to avail the services of an actuary. Now, technically, the services of a qualified actuary are not required as long as insurance company has qualified people in their team to provide the actual valuation report, as well as the disclosures which form a part of AS 15. However, in practice, in real life scenario, we have observed that any valuation which comes from any insurance company, though the valuation may be correct, they may not have all the details which are required for the purpose of making disclosures under AS 15. So in that circumstances, you need to obtain a separate certificate from a qualified actuary in order to do the accounting as well as disclosures as per the Indian GAAP financial statements. The last one we have already discussed. What is the meaning of the phrase market yields at the balance sheet date on government bonds in the context of the discounting rate? Just to reiterate, we discussed that the underlying currency as well as the average service life of particular employees needs to be considered while selecting the proper government bond for calculating the market yield and discount rate. Right, so I think we will take all the questions at the end of this session. We will keep some time for that. So I'll just skip on to the next topic. Whatever questions you have, you can just note it down. If the time permits, we can take it in this session itself. If the time does not permit, either you can call me later on or you can email me all your questions. Moving on to the next topic for the day, which is AS 22, accounting for taxes or income. So again, we as a practitioner, CA practitioner or auditor, we all know the different provisions of Income Tax Act with respect to computation of my tax liability. However, we have noted that in most of the companies, especially in SME sector or even the non-companies, the calculation of deferred tax is ignored. So today we will understand the intricacies and various case studies with respect to how do you compute the deferred tax as per the AS 22. So AS 22 covers both the current tax as well as deferred tax. So as we know, the current tax is very easy to understand. It is nothing but these are the taxes which are payable or recoverable in respect of the current year's profit or loss. And deferred tax is caused because of the timing difference. Now we'll understand what do you mean by timing difference. So current tax and deferred tax put together constitutes this AS 22. AS 22 talks about current tax and deferred tax both. However, 90% of our time will be discussing about the deferred tax, because current tax is more governed by the tax laws in your local jurisdiction. So in India, it will be governed by our Income Tax Act plus income computation and disclosure standards, which are issued by CBDT under Ministry of Finance. So both these laws or guidances will determine the current tax, and deferred tax will be determined by the provisions of this particular accounting standard. Now we all saw that the deferred tax is nothing but it is the effect of timing difference. So we will understand what do you mean by timing difference and what do you mean by permanent difference in a very brief, because I'm sure you must have already read through earlier. So timing difference is nothing but it is a difference between the taxable income and the accounting income for a period that originates in one period and are capable of reversal in one or more subsequent periods. So basically here we are saying that there could be differences in your profit before tax as per your accounting books and tax books, because the accounting rules and income tax rules are different with respect to the accounting. For example, the most common scenario where the timing difference occurs is on account of depreciation. So under the Companies Act, under Indian GAAP, the companies could either follow straight line method of accounting or depreciation or WDV method of depreciation based on the schedule 2, based on the useful lives which are mentioned in schedule 2 of Companies Act 2013. However, under income tax, one needs to follow WDV method based on the rates which are prescribed under the Income Tax Act. Thereby, the depreciation as per Companies Act or Indian GAAP is different to what we record under the income tax, and hence it results into the differential profit, and that difference is nothing but a timing difference. There are various examples in addition to depreciation. For example, provision for doubtful debts. So in Indian GAAP, most of the companies make 100% provision for doubtful debts when the debtor's aging exceeds 6 months or more than 1 year, as the case may be. However, income tax allows the expenditure only when there is an actual impairment of a debtor. Till that point in time, the expenditure is disallowed, which again results into the timing difference. So in accounting books, I am recognizing as an expenditure, but in tax books, the same expenditure is disallowed by income tax authorities, and I will get the benefit of that expenditure when the debtors are actually impaired in the future period. Thereby, the reversal or where the difference which is occurring in the current year is capable of reversing in the future period, thereby causing the timing difference. So deferred tax is recognized on all such timing differences. So I'll also take one example or a case study to understand why the deferred tax is first of all required. And the second is known as a permanent difference. So differences between taxable income and accounting income, which originate in one period but that do not reverse in the subsequent period. As simple as that. So for example, exempt income. So earlier dividend from listed companies was exempt. So it was never taxed. So that became a permanent difference. Or let's say if you have paid any interest or penalty on late payment of TDS, for example, it will be never allowed under the income tax law. So that will be called as a permanent disallowance on which deferred tax is never created. So deferred tax is created only on the timing differences. So we will take one example to understand why the deferred tax is required, why this accounting standard came into picture. So let's assume the initial cost of the building is 1200 rupees. The useful life under the tax is 3 years, and under the accounting scenario it is 6 years. The tax rate is 40%, and annual profit before taxes and depreciation is 2000. So how is income tax calculated? So now we are under a very simple example where profit is constant at 2000 rupees. Under my accounting scenario, accounting books under the Companies Act, I am depreciating the asset over the period of 6 years. So 200, 200, 200 on a straight line basis. So profit before tax is 1800 each year. Now, in the first year, I will first have to calculate the current tax. So how is current tax calculated? Profit before tax and depreciation minus depreciation as per Income Tax Act. So as per Income Tax Act, the depreciation will be 400 because the asset will be depreciated over 3 years. 3 years in tax, and the value is 1200. So 400, 400, 400. Right? So 400 is my tax depreciation. So 2000 minus 400, which is nothing but 1600. So on 1600, my tax rate is 40%. So thereby my current tax is 640, which is I'm actually going to pay to the government. Now, if you consider the effective tax, which is nothing but 640 divided by 1800, my effective tax rate is 36%, which is less than the statutory tax rate of 40%, thereby causing an accounting mismatch. Ideally, my total taxes should have been 1800 into 40% because I need to apply the tax rate on my profit before tax. But because of the timing difference in the depreciation as per the accounting books and the tax books, I am recognizing my current tax at 640, thereby my effective tax rate is 36%. So next year you will have a similar scenario. 1800, 640, 36%, 1160. Third year again similar scenario. Now my asset is fully depreciated as per tax books at the end of the third year. Now when you come to the fourth year, your accounting profit will remain constant at 1800 throughout the life of the asset. However, now the current tax will be directly 40% of 2000 because now my tax depreciation is over. Now fourth year onwards, if you see, my effective tax rate is 44%, which is nothing but 800 divided by 1800. So fourth, fifth and sixth year, I do not have any tax depreciation to be claimed. So I compute the current tax, which is directly 40% of 2000, which is 800, 800 and 800. Thereby my effective tax rate is 44%. Now if you see all these 6 years, my effective tax rate nowhere matches with my statutory tax rate, which is the 40%, which is against the principle of accrual system of accounting. So accrual system of accounting says that your total taxes should be based on the percentage of tax rate. So ideally it should have been 1800 into 40%. That should have been the total taxes. But in all these 6 years, it is not equal to my 40%. Each year the tax amount is different. Thereby my effective tax rate is not equal to the statutory tax rate of 40%. And that is why the deferred tax comes into picture. So let's see how this scenario works in case of the deferred tax. Now under Indian GAAP scenario, one could use either the balance sheet approach or the P&L approach for calculating the deferred tax. Both approaches are allowed. Generally, the companies prefer to have the balance sheet approach so that minimal errors are occurred. There are chances that the company may cause an error if only P&L approach is used. And that is why this example also takes into consideration the balance sheet approach while calculating the deferred tax. Now, what we are doing here is we are comparing the accounting WDV of that particular asset with the tax WDV. So in the first year, if you see tax WDV, the original cost of the asset was 1200 and my tax depreciation was 400 for first 3 years, right? So if you consider the tax WDV, it is 800 in the first year, 400 in the second year, and 0 from third year onwards. So just for simplistic purpose, I am using the SLM basis for tax. However, I know from income tax angle, use the WDV method. This is only for the illustration purpose. From a building accounting WDV, you could see my depreciation as per accounts is 200 throughout the 6 years. So it will be 1000, then 800, 600, 400, and 200. And then last year it will be WD will be 0. The entire asset would be depreciated. Now the timing difference is nothing but it is a difference between the accounting books and the tax books. So in the first year, the timing difference is 200. On 200, I will apply my tax rate, which is 40%, thereby resulting into the deferred tax liability of 80 rupees. Now, why liability and why not asset is also a big question. So what you need to consider is, if I am getting more benefit upfront, for which I will have to pay more taxes in the future period, then it will create a deferred tax liability, which is the consequence right now. So if you see current tax, I'm paying less current tax in first 3 years and then more taxes in fourth, fifth, and sixth year. Why? Because we are claiming more depreciation under tax loss as compared to the accounting loss. So effectively, I am going to pay more income tax in fourth, fifth, and sixth year. And that is why, since I have paid less tax in the current year, I will have to pay more taxes in the future year. And that's the reason you create a liability for deferred tax. So first I compute the WDV as per tax, then WDV as per accounts. The difference is nothing but the timing difference. On that we apply the tax percentage, thereby resulting into a deferred tax liability or asset. If you are getting more benefit upfront, for which you are going to pay more taxes in the future period, it will result into deferred tax liability and vice versa. So 80 rupees is my tax deferred tax expense and liability. So if you see current tax expense, which was 640 as per the last calculation here, 640 for first 3 years. Now 640 is my current tax. My deferred tax is 80 rupees in the first year. Thereby my total tax expense is 720. Now if you divide 720 divided by 1800, which is my PBT, your effective tax rate becomes 40%, which is also my statutory tax rate. So the objective of deferred tax creation is to match the effective tax rate to the statutory tax rate to the extent possible. I understand that this scenario may not work for the areas where there are permanent differences, but certainly yes, wherever there are timing differences, you will have to create a deferred tax. The similar situation will occur for second, third, fourth, fifth, and sixth year. If you see the WDV of tax, it will be 400 and accounting WDV 800. This timing difference will now increase from 200 to 400 in the second year. So the total liability will have to be on 400. So 400 into 40%, which is 160. So the total liability to be recognized at the end of second year will be 160, out of which we have already created a liability of 80 in the first year, and therefore you will only recognize the balance 80 in the second year. So again, 640 is my current tax expense, 80 rupees is my deferred tax expense, and total expense 720. Again, my statutory and effective tax rate is 40%. In third year, your tax WDV is nil, your building WD is 600, your timing difference has increased from 400 to 600. So again, 40% of 600 is 240, out of which I have already recognized 160. So again, incremental deferred tax is 80. So the situation is same in the third year again. Now in the fourth year, so till the end of third year, we have created a deferred tax liability. Now in the fourth year, this deferred tax liability that we have created will start reversing, and ultimately it will become zero at the end of sixth year, because it is in the nature of timing difference. Now if you see the fourth year, your tax WDV is 0, your building WDV is 400, the deferred tax liability is now 160. So it has reduced from 240 to 160, now thereby resulting into reversal of deferred tax expense or creation of deferred tax income. So if you see the current tax, you are paying 800, 800 and 800 in fourth, fifth and sixth year. So your current tax is 800, your deferred tax income is 80 rupees, thereby my total income tax, which is nothing but current plus deferred tax, is again 720, thereby resulting into effective tax rate of 40. So this difference will go on reducing. So whatever liability that I have created, that will go on decreasing. And if you see this calculations, ultimately for the same profit, the same tax expenditure is recognized throughout the period of 6 years, which is 720, after giving the effect of deferred tax. This is the objective of this deferred tax standard, that whatever is my accounting profit before tax, if I multiply the statutory tax rate, I should have the same taxes with respect to both current and deferred tax, and my effective tax rate should match with my statutory tax rate. Moving on to the next slide. So this is where I have tried to kind of give you more examples where the deferred taxes would be created because of the timing differences. So we all know that if any employee benefits, taxes, duties, cess, which are accrued but that are not paid, then again those are disallowed and are allowed only on payment basis under section 43B of income tax. So thereby creating a deferred tax asset, because I'll be paying more taxes in the current period, for which I will be getting the benefit in the subsequent period. So I will recognize deferred tax asset. Then again, if the TDS is not deducted, then again it will be disallowed in the current year. So whenever TDS is paid, deducted and paid, again that expenditure will be allowed. So again, thereby creating a timing difference. Some companies also create provisions like provision for warranty. It is again disallowed under income tax unless it is paid in the subsequent period. So again, deferred tax asset would be created on this timing differences. And of course, the differences in depreciation rates or methods could also create this timing differences, thereby creation of a deferred tax asset or a liability. There are some examples of permanent differences like exempt income. So if your organization or entity is kind of doing a business in a very remote area where there are some, let's say 10I, 10B benefits, then again the actual income is exempt, so we will not create any deferred tax on that. Then expenses which are disallowed on a permanent basis, like for example interest or penalties on TDS or any other dues are allowed on a permanent, are disallowed on a permanent basis. So again, it will be a part of permanent differences on which deferred tax is not required. And then we also have additional weighted deduction. So if you have purchased any scientific or a plant and machinery which is used for any scientific research and all, and you get 125% deduction, 150% deduction, something sort of that, then additional deduction will also form a part of permanent differences. There's one very pretty interesting case study here. I'm sure nobody would have considered this example or a case study for creating a deferred tax in Indian GAAP financial statements. This was pretty much considered under Ind AS scenario, but now even under Indian GAAP, the recent standards which were issued and which became applicable from 1st April 2021 onwards, there is a specific paragraph in AS 22 which talks about deferred taxation on long-term capital asset. So I'll take an example. So this is what it says. The para, it says that in cases where there is a difference between the amounts of loss recognized for accounting purpose and tax purpose because of the cost indexation benefit under Income Tax Act in respect of capital assets, long-term capital assets, deferred tax asset is recognized and carried forward subject to prudence on the amount which can be carried forward and set off in future years as per the provisions of income tax. Now, what do I mean by this provision which is stated under AS 22? So let me give you an example. Let's say I have purchased a land at the cost of 1 lakh rupees. Okay, this is the cost of land. So we all know that land is a capital asset and index cost of acquisition is applicable for computing the total cost or capital gain when the long-term capital asset is actually sold in the future period. Okay. Now, let's say carrying amount of land, that is the cost, which is effectively cost because we do not provide any depreciation on land. So this is cost. Cost is 1 lakh. Now on today's date, my index cost of acquisition is, assuming it is 1.5 million or 15 lakh rupees, considering all the cost section index and etc. Now the standard says because there is a difference between the cost and the index cost, this has resulted into a timing difference. So how this timing difference will work out, I will let you know. So let's say my tax rate is 20%. Okay. So my carrying amount of the land, that is WTV, as per books is 1 lakh rupees. And WTV, if I have to sell land on today's date, as per income tax law, it is 15 lakh rupees. And thereby there is a timing difference. So the standard says create a deferred tax asset on that timing difference. So 15 lakhs minus 1 lakh, which is 14 lakhs into 20%, which is 2,80,000. This is a deferred tax asset which is created. We will discuss when to create, when to not later on. But this is what the standard tells you to recognize. 20% of timing difference. So this is a DTA. Okay. Now when this deferred tax asset will reverse, this will reverse when the company actually sells the land in the future period. So considering an example, the sale price is 20 lakhs. Okay. Next year, this land is sold for 20 lakhs. Now, what is the actual capital gain? The actual capital gain will be sale proceeds of 20 minus index cost of acquisition of 15. I'm assuming it 15 for the sake of simplicity right now. So my capital gain is 5 lakhs and my 20% is my long-term capital gain rate. So my current tax is basically 1 lakh rupees, which is nothing but 20% of this 5 lakhs. So current tax is 1 lakh, correct? And I already have 2,80,000 as my deferred tax asset. Now, since there is no difference, there is no timing difference between the accounting books and the tax books, it is 0 because I have sold the land. This deferred tax asset will be reversed and it will create an expenditure. So 2.8 lakhs will be deferred tax expense. So thereby my total expense is 3.80. Okay, so 3.80 is my total expense now. Now, if you calculate accounting profit, what is my accounting profit? It is nothing but 20 lakhs is my sale proceeds and 1 lakh is my cost. So my accounting profit is nothing but 19 lakhs. Okay, accounting profit is my 19 lakhs, which is nothing but sale minus cost, simple formula. And now what is my total tax? 1 lakh is my current tax and 2.8 lakhs is my deferred tax, which is nothing but reversal of DTA, 3.8 lakhs. Now, if you say 3.8 lakhs is my total tax, 19 lakhs is my accounting profit. If you compute effective tax, will be 20%. So this is what again deferred tax is trying to achieve here. So when the asset is sold or retired, then at that point of time, your effective rate should be equal to your statutory tax rate. That is the objective of deferred tax. Now, why most of the companies are not creating a deferred tax asset on such long-term capital asset is, first of all, we don't know that when this asset will be, or when this temporary difference will, or when this timing difference will reverse in the future, because the entity may not have intention to sell the land in the foreseeable future. And second is whether enough profits will be available in the future period to set up this deferred tax asset is the second question. So considering these two situations, there are a lot of companies who are not creating deferred tax asset, but the provision is there. So let's say tomorrow in your board meeting or in a directors meeting or at a very high level meeting, there is a proposal that the land needs to be sold. Then you do not have an option but to create deferred tax assets on such type of long-term capital gains, especially arising because of the index cost of acquisition. So this was the most ignored area in AS 22, which one should be aware about. And the last part is on the deferred taxes on losses and unabsorbed depreciation. So AS 22 says that in case the company has losses, carry forward losses, or it has unabsorbed depreciation, one can create deferred tax asset on those losses only when there is a virtual certainty which is supported by convincing evidence that future taxable profits will be available against which deferred tax can be realized. So these are the two important words: virtual certainty and convincing evidence. What is virtual certainty? There is no definition as such of virtual certainty. However, in practice, it is considered that there are more than 90% chances. There are more than 90% chances that there will be future taxable profits for which I can use the available carry forward losses. And convincing evidence. So what is my convincing evidence? So convincing evidence will not constitute budgets, forecasts, plans, etc. The standard specifically says that the evidence available should be in the concrete form, that is binding sales order, binding profitable sales order or an export order, cancellation of which will result into payment of heavy damages by the defaulting party. So that should be the convincing evidence. Mere forecast, performance, business plans will not constitute a convincing evidence. Future projections, the projections which are considered for the valuation purpose or restructuring purpose, all these will not be considered as a convincing evidence. You should have binding profitable sales orders in hand, which will be considered as a convincing evidence if you really want to recognize the deferred tax asset on the carry forward losses or on the unabsorbed depreciation. So there's a case study around it. Company ABC was established 1 year ago and it is in a startup phase. In its first year of operations, ABC had a loss of 5 lakh rupees from a taxation perspective. ABC does not have any deferred tax liability as such against which this deferred tax asset can be set off. ABC expects to be profitable by the end of third year of operations and expects all tax losses to be utilized by the end of fifth year of operations. So we are only saying expected to be profitable. We do not have any convincing evidence. We do not have binding sales order. If they are cancelled, would kind of have heavy damages. It's all in forecast, business plans, etc. So it says that in the absence of any convincing evidence, ABC will not be in any position to recognize the deferred tax asset with respect to tax losses. So if you're an auditor of a company and your client is suffering losses, then you should always ask for the existing agreements, the sales order, the purchase order, whatever it is, to support whether there is a convincing evidence that future taxable profit should be generated in order to set off the carry forward losses. In those circumstances only, you can create a deferred tax asset on carry forward losses and unabsorbed depreciation. In case of deferred tax asset resulting from any other areas like provision, disallowance of provision for bad and doubtful debts or 43 bits disallowance, etc., then only reasonable certainty with respect to profitability is required. Virtual certainty supported by convincing evidence is not required. Yeah, so this was with respect to deferred tax. Of course, we could not cover the entire standard in detail, both AS 15 as well as AS 22. I just took the important parts of the standard, which will help us to understand the core concept of the standard, along with few new areas and the case studies relating to those concepts. So again, if you have any questions with respect to AS 22, you could just note it down. We will take all the questions at the end of the session, or if the time does not permit, you can always write to me all your questions. The third standard that we are going to discuss today is AS 11, the effects of changes in the foreign exchange rates. Again, a very important standard with respect to the profitability of the company. So you could have realized both AS 15 also has a large impact on profitability of the company, especially with respect to the actuarial valuation, the discount rates, etc. Income taxes from the recognition of deferred tax also. And because of the foreign exchange rates, the fluctuations in the foreign exchange rates could also create a lot of volatility in the profitability of the company. So we are going to discuss the key concepts of AS 11 as well as few examples and case studies of how this standard is actually applied in practice. So basically the objective of this standard is to deal with two major parts of an accounting. The first part is with respect to accounting for transactions which are executed in foreign currencies. So if any company is exporting their goods or services or importing any goods or services, or they have obtained any loan in a foreign currency like ECB, then how do you convert the foreign currency balances into your reporting or presentation currency. That is the first objective of this standard of prescribing an accounting for such type of transactions. And second is translation of financial statements of your foreign operations. Like when you are preparing the consolidated financial statements, and if you have any branches, subsidiaries, associates, or joint ventures outside your local country, let's say outside India, then how do you convert the financial statements of those companies which are into foreign currency, like it may be USD, Euro, or GBP, etc., into your reporting currency? So there are various rules which are prescribed from the conversion perspective. So we are going to understand those rules and case studies around those particular rules. And third is it also deals with certain foreign currency transactions which are forward contracts where there is an underlying asset or a liability. Now, whenever you do any major exports or you have borrowings or you have imports, a lot of companies enter into the forward exchange contracts for hedging their foreign currency risk. Now, there are two types of contracts. The contracts wherever there is an underlying instrument or underlying asset or a liability. For example, I have foreign currency debtors, I have foreign currency suppliers, etc., on which I have taken a forward cover. So there is an underlying asset or a liability against which the hedging is done. Only such type of scenarios are covered by AS11. Okay. There is also a scenario, or there could be a possible scenario where the forward contracts are entered into for hedging of forecasted sales or firm commitments for which we do not have any underlying asset or a liability. Such scenarios are not covered by AS11. Such scenarios are covered by a separate guidance note on derivative contracts issued by Institute of Chartered Accountants of India. So we need to be absolutely sure that if there are underlying assets and liabilities on which forward covers are taken, then only it will be a part of AS11. Otherwise, it will form a part of guidance note on derivative contracts. So let us understand the currency transactions. So how do I convert my existing foreign currency balance into my presentation or reporting currency, let's say INR? So the standard is very clear. As on the date of initial transaction, that is day one, when you enter into a particular transaction of sale, purchase, borrowing, acquisition of fixed asset, it may be any transaction. So at the date of transaction, you need to convert that foreign currency amount into your local currency using the rate as at the date of transaction date. So whatever is the rate, I mean the exchange rate, like if it's 1 USD is equal to 78 rupees, I will use that rate for conversion from foreign currency into local currency. Or if there are series of transactions, one after the other, then you can also use an appropriate average exchange rate for conversion of your foreign currency into local currency. Now, theoretically, we say that yes, the rate as on the transaction date. But then I will ask you one question, that there are so many rates which are available in the market. There could be an RBI rate, there could be SBI rate. There are so many websites like xc.com or onda.com. So there are various conversion rates which are available for conversion of your foreign currency amounts into local currency. So which rate should I consider? Whether should I go to an RBI site or SBI site or this XC site or OND site? Which site? So the standard is not pretty clear. What do you mean by transaction date? Okay. Generally, we all say that the spot rate should be considered for conversion from the foreign currency amount into local currency. Now, what is the spot rate? Again, is a question. So in practice, generally what you should do or what you should suggest to your client is the rate which is given by your banker. Let's say you have HDFC, ICICI, Kotak or any other bank. If you go to your bank on today's date and convert 100 United States dollar into Indian rupees, what is the rate that bank will provide you? That rate for immediate delivery is called as a spot rate, and then spot rate should be ideally used for conversion of any foreign currency balance or foreign currency amount into the local currency, which could be Indian rupees. So these are the very small things that one should keep in mind for conversion of any foreign currency transaction into your reporting currency. So spot rate, which is available for immediate delivery, given by your company's banker, and no other site or bank should be referred for translation. Now for the this was for the initial translation, right? But initial translation, there could be debtors and creditors which is still sitting on your balance sheet. So what happens at the subsequent translation? So for subsequent translation, we need to bifurcate a particular asset or a liability into monetary item and non-monetary item. So monetary item is nothing but it is those assets and liabilities that will be received or paid in fixed or determinable number of units of currency. So I know for sure that this amount I will get on today's date. So example, cash and bank. It is fixed and it is determinable, or receivables from debtors or payable to your suppliers, creditors, etc. Or loan amounts which are payable or loan receivable. These are the fixed or determinable number of units of currency, and these are called as monetary items. Non-monetary items are nothing but the items that will not be received or paid in fixed or determinable number of units of currency. So for example, the values could differ. You cannot assign a fixed value to that particular asset or liability. So it could be fixed assets, your intangible assets, your inventories, or your investment in equity shares, for which you do not have a specific determinable amount of unit of currency. The monetary items and non-monetary items classification is very important for translation of those foreign currency balances as on the reporting period, that is the closing date or the balance sheet year-end date. So monetary items are converted at the rate as on the reporting date, which could be quarter reporting, month-end reporting, half-year reporting, or it could be yearly reporting. So you need to consider the closing rate as on that date and apply the foreign currency rate to convert from foreign currency into your local or presentation currency. For non-monetary items which are measured at historical cost, the rate as on the transaction date. So if I have purchased a fixed asset on today's date, I will use the today's date rate for conversion of foreign currency into presentation currency. Thereafter, I do not again change the rate unless that asset is revalued in the future. If it is revalued in the future, then only I will consider the rate as on the date of revaluation. Till that date, I continue to use the rate which was applicable as on the date of the transaction. So if it is monetary item, you restate on each balance sheet date or each reporting date using the closing rate. If it is a non-monetary item like fixed assets, inventories, investments in equity shares, whatever was the rate applicable as on the transaction date, we use it for the reporting into local currency. Now, capital advance is a classic example where a lot of companies go wrong in translation. So capital advance, let's say I am buying or importing a machinery from a foreign party. So 100 rupees is a total, or $100 is a total cost. I have paid an advance of $50. So that $50 is treated as a non-monetary item, and I will not subsequently revalue that $50. It will be considered as non-monetary item, and whatever is the translation amount of that $50, it would straight away be added as a cost of my fixed asset when the fixed asset possession is received and the ownership is transferred. So this is most common mistake that I have found out while consulting or auditing, that the capital balance or capital advance amount or capital WIP account is again revalued to the current year's rate or the date of transaction when the fixed asset is arrived in the factory. That should not be done for measuring your value of your property, plant and equipment. It will be the old same rate. What happens in case of monetary items about the exchange differences? Because we are measuring your monetary item like receivables, payables, cash bank in foreign currency into your presentation currency and changing on each reporting date. So let us say when I booked the sale, the debtor was 72 rupees, but now as on the closing date, the debtor value is 78 rupees because of the increase in the or depreciation in the value of the rupee. So 6 rupees per dollar is my gain, unrealized gain, which is sitting. So all realized gains and losses as well as unrealized gains or losses are recognized in profit and loss subject to certain exemptions, either in the relevant line item or as a part of other income or other expenses. So please note all the differences, realized as well as unrealized foreign exchange gain or losses are recognized in your profit and loss statement subject to certain exceptions. Now, what is this exception that we are talking about? There is one exception which was introduced somewhere, I think in 2012 or so. I don't exactly remember the year, which is a para 46A of ACE 11. So it says that a company has an option. It is option, it is not compulsory. A company has an option to capitalize the foreign exchange differences on your long-term monetary, long-term foreign currency monetary items incurred for acquisition of fixed assets and to amortize these differences on other long-term monetary differences over the life of such items, but not beyond the stipulated date. So to give you a classic example, let's say you have obtained a foreign currency borrowing for the import of your plant and machinery. So this borrowing is directly related to the acquisition of your fixed asset. Now, while paying a borrowing is a monetary item. Loan in a foreign currency is a monetary item. So on each reporting date, it may be monthly, quarterly, half yearly or yearly, you will be restating your foreign currency borrowing at the closing rate as on the date of reporting. So every reporting date, there will be a gain or loss, unrealized gain or loss on foreign exchange translation. So the entities in India under Indian GAAP has a choice to capitalize such foreign exchange gain losses as a part of fixed assets. So this para 46A talks about the capitalization of these exchange amounts as a part of your fixed assets. If it is not relating to the fixed assets, it may be relating to some other items which are not fixed assets, then the standard allows you to accumulate all such gains or losses in a separate account which is called as FCMI TDA, Foreign Currency Monetary Item Translation Difference Account, FCMI TDA, and recognize the exchange gain or losses over the period of that long-term monetary item, which is a loan amount over the period of 10 years. So this is an option which is only given under ACE 11. We do not have such options which is under Ind AS or IFRS. I think under income tax also, income tax requires you to capitalize such exchange differences or losses. So we'll take quickly one example or a case study. So again, I'll try to share my experience regarding this foreign exchange gain or losses. Now, a lot of companies have subsidiaries, associates, and joint ventures, and there are transactions between these group companies. So let us say there is an Indian entity, and then there is a foreign entity which is based in US. So let's take an example where a US based company parent entity has given a loan to a subsidiary company in India. Let's say it's a $100 loan. Okay. So $100 loan is sitting in US books as loan given, and the same $100 loan is sitting in India books. Okay, so $100 is a loan amount. So this is US and then this is India. So in US books, US is preparing anyways under USD. So there is no foreign exchange gain or loss, realized, unrealized, nothing is there because it is the same currency. In India, this loan is getting converted into rupees, and India is recognizing gain or loss, right, on this foreign exchange translation on each reporting date. Now the question is, let's say US is preparing the consolidated financial statement. Okay, the US is preparing consolidated financial statements where India is one of its subsidiaries. Now we have all studied in the past that in case of consolidated financial statements, we have to eliminate the intercompany balances as well as transactions, right? Now $100 receivable from India and $100 payable from India to US. This is an intercompany balance, which I completely agree that it has to be eliminated on consolidation. However, India also has recorded foreign exchange gain or loss on conversion of these $100 into Indian rupees. Now the question is, along with the normal $100 payable and receivable, whether the foreign exchange gain or loss also should be eliminated as a part of intercompany transaction. And the answer to it is no. The reason behind it is, even if it is an intercompany transaction, the group overall has a real exposure to the changes in the foreign currency risk, because ultimately the Indian entity is going to shell out more dollars or more Indian rupees or less Indian rupees because of the changes in the foreign exchange rates. And therefore, whatever is the unrealized or realized foreign exchange gain or loss, that will be continued to be recognized as the foreign exchange gain or loss even in the consolidated financial statements. This is a very important point where I've seen a lot of companies have made mistakes in the elimination process of intercompany loan, which is in foreign exchange. So all of you just keep in mind, while elimination, the if the group is having the foreign currency exposure, it will continue to be recorded even in the consolidated financial statements. Moving on to the next slide. Currently, we discuss about the translation of foreign currency transactions which occur in your own books of accounts. Now, in the next segment, we are going to discuss about translation of foreign currency operations into the parent's reporting or the presentation currency. This situation typically occurs when you have foreign subsidiaries, associates, or joint ventures, and you need to convert the financial statements of those foreign operations into your reporting or local currency. So first of all, AS11 has defined what is a foreign operation, which is a very simple and straightforward definition. It says a foreign operation could be a subsidiary, associate, or a joint venture, or a branch of a reporting entity whose activities are based or conducted in a country or currency other than those of a reporting entity. So let's say India is a reporting entity, India ABC is a reporting entity, and if ABC is having any subsidiary, associate, JV, or branch outside India, or there is a company whose financial statements are prepared in a different currency, that will be called as a foreign operation from an Indian reporting Indian reporting company's perspective. Further, the standard also tells us to distinguish a foreign operation as integral operation or a non-integral operation based on certain indications. So those indications are very important because the accounting for integral operations and non-integral operations is significantly different, which will have huge impact on the profitability of the company. So there are various indicators for classifying whether a particular operation, foreign operation, is an integral operation or a non-integral operation. So we will just discuss few of those criteria in order to determine the integral and non-integral classification. So the first criteria is whether activities are conducted by the foreign operation with a significant degree of autonomy, or they are completely dependent on the parent reporting entity. So if the foreign operation is working on its own, they have their own board, they are taking their own decisions, they are autonomous, they are not dependent on any other company for regulation of their activities, then we can say it is a non-integral operation. However, they are completely dependent on each and every decision with the reporting entity, let's say based out of India, then it will be an integral operation. Then the second question is whether the transactions with the reporting enterprise are of high proportion that of a foreign operations activities. So if there are transactions like 100% sale is or 100% purchase is done from the reporting enterprise, entire borrowing is done by the reporting enterprise. So if the volume of transactions is really high, then the tilt is towards the integral operation. However, if the volume of transactions is low between the foreign operation and the reporting entity, then again the indication is towards a non-integral operation. Then next we need to see whether the foreign operations finances are mainly done from its own operations or they are completely dependent on the reporting entity. So because of the internal reserves, internal transactions, if the foreign operation is sufficiently kind of financed from its internal operation, then again it is towards non-integral operation. If they are heavily dependent on the reporting enterprise continuously from the funding perspective, then again it is an indication towards integral operation. Then the next point that we need to see whether the expenses are paid and settled in the local currency of that foreign operation or they are settled in the currency of the reporting enterprise. If the expenses are paid and settled within the local currency of the foreign operation, then again it is non-integral and vice versa. The next point we need to check whether the foreign operation sales are in the local currency or they are again in the currency of the reporting enterprise. So if the sales are in the local currency of the foreign operation, then again it is a non-integral operation and vice versa. Then we need to check whether the cash flows of this reporting enterprise are insulated from day-to-day activities of the foreign operation. So what do you mean by that? So let us say that the foreign operation is completely dependent on the reporting currency. So reporting currency has sold something to foreign operation, and in turn immediately by adding up some markup, foreign operation is selling it to the companies in their local country. And whenever their sale proceeds come to the foreign operation, they are again giving back to the reporting entity on an immediate basis. So reporting entities cash flows are dependent on foreign operation. They are not insulated. In that case, it is an integral operation, otherwise vice versa. Then we need to check the currency of the country whose competitive forces are determining the sales price. Very important question. So when I determine the sale price of my product or a service, whether it is based on the local forces, local competitive forces of that particular country, or again it is determined by the reporting entity. So if it is determined by the local competitive forces of the foreign operation, then again it is towards a non-integral operation, or otherwise it could be integral operation. And the last one is whether there are active local sales market of the foreign operation product. So that is more of an indication of non-integral. Although there may be some exports, but if there are more local sales, then it is an indication of non-integral operation. So we need to consider all these factors in tandem to decide whether a foreign operation is an integral operation or a non-integral operation. In some cases, probably you may not get a very straightforward answer, and you may have to apply your judgment and estimate in deciding whether a particular foreign operation is a integral operation or a non-integral operation. Now, if you conclude that if it is an integral operation, then we have to apply the same principles that we saw for accounting for transactions in foreign currencies. So all your P&L related balances will be converted as on the transaction date or average exchange rate. For all the balance sheet items, you need to bifurcate as monetary item and non-monetary item. The exchange gain or loss will be recognized in your P&L subject to certain exemptions. So every accounting aspect which we discussed few minutes back will be applicable for integral operation. So if you are classifying a foreign operation as an integral operation, then it will affect the profitability of your consolidated financial statements in a very big way, because all the foreign exchange differences will be recognized in the consolidated financial statements of the parent entity, thereby causing huge volatility in the consolidated profitability of the overall group. So we need to be absolutely sure to classify whether a foreign operation is an integral operation or a non-integral operation. Going back to the non-integral operation, we will discuss how do you account for the non-integral foreign operation. So we divide it into three categories. First is assets and liabilities. Second is income and expenses, which are P&L items. And third is the equity transactions. So the accounting is pretty simple. All your asset and liability, including your goodwill, capital reserve, goodwill, etc., would be converted into your reporting currency as on the closing date or the reporting date. So if you are preparing your financial statement for 31st March closing, it will be 31st March. All assets and liabilities, irrespective of whether they are monetary or non-monetary. Then the second is income and expense. These are converted into the transaction date balances or appropriate average exchange rate. Generally, the transaction date amounts are not available in practice. So in 99.99% cases, appropriate average exchange rates are used for conversion of all the income and expense related items. And equity transactions will be converted as on the rate of the transaction date. So basically, if the investor has introduced share capital in a foreign currency, the rate on which the share capital was introduced will be considered for the conversion. Or if, let's say, the profits of the foreign operation, they will be converted into the appropriate average exchange rates of the respective years. So this is how the conversion will be done. Now we have a trial balance, let's say in USD, which is a tallied trial balance. However, when you apply these rates, so in some cases we are applying average exchange rate, in some cases we are applying closing rate, in some cases we are applying the transaction date rates, etc. So when you convert, let's say, a trial balance of USD into INR by using all these methodologies, there will be some difference while calculating the total impact. That difference is recognized in a separate component of equity, which is called as a foreign currency translation reserve. This amount does not get recognized in the P&L. It gets recognized as a separate component of your reserves and surplus, which is called as a foreign currency translation reserve. So each year the company needs to compute this foreign exchange translation reserve. The movement does not happen through P&L, it is adjusted in reserves itself. So we will take one case study or an example to understand how this foreign currency translation actually works in practice. So ABC has a reporting currency of USD and it needs to be translated in the financial statements into presentation currency of PQR, which is a euro. So we have provided a balance sheet of ABC into USD. So we have property, plant and equipment, receivables, issued capital, opening retained earnings, profit for the year, long-term liabilities and accounts payable. And we already have the rate as on the transaction date for my equity items, which is 30,055 euros for 50,000 USD and 50,274 for 28,000 opening retained earnings. In the subsequent slide, we have relevant exchange rates. So exchange rate euro to USD 1.22 at the beginning of the year. Average exchange rate is 1.175 and rate at the end, which is nothing but closing rate, is 1.13. So we need to translate the balance sheet of ABC into euros for preparing the consolidated financial statements of PQR. Obviously, we have the ready-made amount for share capital and retained earnings. So what will happen? This 50,000, which is a asset, will get converted into the closing rate, which is 44,000. Then again receivables, which is an again asset, which is converted into closing rate. So we have 871,682 as total assets after conversion into closing rate. For issued capital, we already have the amount. For opening retained earnings, we already have the amount. This is the rate as on the transaction date. Profit for the year, we will apply the average exchange rate because these are nothing but your items of your income and expenditure. So for profit for the year, which is 20,000 USD, I multiply by 1.175 to arrive at the euro amount. Then long-term liability and accounts payable both are liability items. So that will again get converted into the closing rate. Thereby, my total of equity and liabilities is 847,306. Right? And the difference between these two will be nothing but my FCTR, which is 24,376. Right? So this is how the financial statements of a foreign company are converted into the reporting company. So 24,376 will be basically an FCTR amount, which will be a part of the reserves and surpluses. So this is what I wanted to talk about the foreign currency transactions or AS11. We could cover majority of the sections of this standard and the practical aspects of implementing the transaction date, the conversion of financial statements, something about the capital advance, etc. So again, you can just note down the questions relating to AS11. We can take it at the end. So the last standard which we are going to cover is basically on impairment of assets. Again, there's a lot of theory around AS28 impairment of assets. However, a lot of few companies are actually implementing in real sense about this standard. So we are going to cover the brief aspects of this particular standard and how it works in practice. So the core principle of AS28 is that entity's assets at its book value should not be carried at an amount which is more than the recoverable amount of those assets. Okay, an asset is impaired when the carrying amount of asset is basically greater than the recoverable value of that asset. So I'm sure everybody knows what do you mean by recoverable value. It is generally the net selling price of that asset on any given date or value in use, whichever is higher. So net selling value is basically you have to sell the asset on today's date. After selling cost, what would be the value? And value in use in nothing but it is the present value of the net cash flows which are expected from the usage of that particular asset. Right? So we'll discuss what are the different indicators for impairment. The first indicator is significant decline in the market value of asset. So this could be on account of various aspects. The demand is less, or there is obsolescence, or there could be various other factors relating to the market value of an asset. So first is decline in the value of the asset. The second is adverse impact on the technological market or legal environment. Government has banned the usage of that particular asset, or the technology has become so advanced that your asset is basically redundant in nature. So that could be different circumstances. Or there could be changes in the market rates, which could have significantly affected your investments. That could be one of the factors. Or the carrying amount of the net assets is lesser than the market capitalization. So the value of your company is basically less as compared to the carrying value. So these are some of the external factors. So please note that these are only indicator. The list is not exhaustive. And then there could be internal factors like it has become obsolete for your business, or there has been a physical damage because of accident, or the value or the performance is declining because of the maintenance, or asset becoming idle, or because of the low demand you are not able to utilize the asset. You plan to discontinue a particular plant, you're restructuring your business activities. So these could be some internal factors. There is also a possibility that originally you had budgeted that X amount of cash flows will be received after maintenance and etc. But there is a possibility that the total net cash outflows are much lesser than those budgeted, right? So these are various factors which one should consider as an indicator for an impairment of asset. As I told you earlier, this list is illustrative and not exhaustive. There could be many more factors apart from the factors listed in this particular slide. One also needs to keep in mind that the asset is always tested at the CGO level, that is cash generating unit level. So a cash generating unit is the lowest possible of a group of assets where it could independently generate cash. So the company generally does not look at the standalone asset unless it independently can generate the cash flows for the company. So while testing a particular asset for an impairment, the company should look at the CGU level, that is cash generating unit level, which could be one asset or group of assets producing the actual net cash flows to the company. So we'll select few case studies, we'll discuss few case studies before we wind up relating to the impairment. A bus company provides services under the contract with a municipality that requires minimum service on each of the 5 separate routes. So basically there are 5 separate routes for which 5 buses are deployed. Assets devoted to each route and these cash flows from each route can be identified separately. So we can know that this is a total revenue, this is a total profit from each of the routes separately. One of the routes operates at a significant loss. How a company shall assess the CGU for impairment testing if required? Now, one, we need to check the contract with that municipality. If the contract says that you need to operate all the 5 routes, even if there is a loss in the one route, then the contract is not separated. It is overall one contract where you cannot distinguish the separate routes. In this particular scenario, according to us, a separate route which is a loss making route will not be considered for impairment, but overall all these 5 routes should be considered as a CGU for identifying whether an impairment loss is occurred, because as a company I do not have a choice to select a particular route for providing the services. So either you provide the services on all 5 routes or you do not provide any services. The moment you have an option to provide the services on a single route, then yes, that single route will be considered for an impairment. But if you do not have a choice but to provide services under all 5 routes, then a separate impairment testing is not required, provided all the 5 routes are in a beneficial stage. The second question is PQR Limited has two plants. Plant P produces raw material that is sold to plant Q. So there is an internal transfer between two plants. The raw material is sold by plant P to plant Q at a price that transfers all the margins to plant P. So at a margin they are selling. 55% of the plant P's production is sold to plant Q and 45 is sold to external customers outside PQR Limited. So there is a substantial amount which is sold to outside customers as well. 85% of Q's production is sold to external customers of PQR. So again, there is no internal, most of the production is to outside customers. The issue is to determine the CGUs for plant P and Q in two scenarios mentioned below. Plant P could sell its production in an active market instead of to plant Q. So in first circumstance, we are saying plant P can sell it to external parties also and can sell it to internal parties also. So in that case, they are operating on its own. They are not depending only on Q. In first circumstances, since plant P has an active market, so even if Q does not take the output, plant P can sell it to external customers. Since it has an active market outside the PQR Limited group, plant P and plant Q will be considered as two separate CGUs since it has active market. But in case 2, no active market for production of plant P. So if plant P does not have any active market, but it has to compulsorily sell it to Q, then its cash flows are dependent on plant Q. So the company would overall consider plant P and plant Q as a single operating unit because plant P cannot function on its own or it cannot generate cash flow on its own. It is dependent on the other unit of the company or other CGU of the company. So in case of second scenario, plant P and plant Q both would be considered as one CGU together. But if plant P has an active market outside plant Q, then both plants will be considered as two separate CGUs. Then the third example. An entity is closing a division after the year end. No provision has been made for redundancies at the year end because the announcement of the closure was not made until the end of the year. However, entity is looking at the impairment of the division's assets. Out of the total property, plant and equipment, the plant and equipment are likely to be impaired as the recoverable amount is expected to be lower than the carrying amount. However, property is expected to be sold at a profit. So we are saying here the plant and machinery is at loss where the carrying amount is lower than the recoverable value. However, the property can be sold at a reasonable profit. In determining the charge for the impairment at the year end, does the entity consider the total assets of the division, including the property, as one CGU, or look at the individual assets? The profit expected to be made on the property is large enough to offset impairment of the plant. Now one must again go and check what are the different CGUs. So there is a possibility that the total plant and equipment can itself generate the independent cash flows for the entity. So in that particular scenario, the property, plant and equipment, that is only plant and equipment, will be considered as an independent CGU, and the property which could generate again the sufficient cash flows will be considered as a separate CGU. So if the carrying amount is less than the recoverable amount relating to the plant and machinery, the impairment testing will be done. In case there is an impairment loss, that will be recognized in your P&L, and property will be continued to be recognized at its cost. So both plant and equipment and property will be considered as two separate CGUs. On plant and equipment, there will be an impairment loss, and in case of property, plant and equipment, it will be continued to be recognized at cost. Now, what is frequency of impairment testing? So generally, when you have identified a cash generating unit which has goodwill or intangible assets with indefinite useful lives, if an indication exists, you have to immediately perform the impairment test. If there is no indication, you have to at least carry out the impairment test at least on an annually basis. There is no specific time frame which is given. It could be year end, it could be between middle of the year, but it has to be on a consistent basis. So let's say if you are doing an impairment test at the end of 6 months, so every 6 months you need to do the impairment test. So it could be done at any point in the year, but consistently during the same period. In case if it is an individual asset other than above, individual asset apart from the intangible or goodwill, if an indication exists to the performance, perform the impairment test immediately. If there is no indication, that impairment testing may not be required. However, in practice, even if the impairment indication does not exist, companies do it at least for every 3 years. One more case study. An entity is an automobile component supply business. It has 31st December as the year end. The entity generally performs its annual impairment review during the month of September each year. During the year 2014 as well, entity carried out impairment review in September in line with the budgeted information. However, in October 14, two major customers announced a shutdown of their sites for a prolonged period. How entity should use this information? So the standard says that apart from your normal annual impairment testing, if there are additional indicators which occur, then the entity should go ahead and carry out again an impairment testing even immediately after the 1 year. So in September 14, the impairment testing was conducted. However, after 1 month's time, there was new indication, new factors which led to the impairment testing. So this new information should be considered for the purpose of testing again in October 2014. Right, so we'll talk about something about recoverable value. So as I told you, impairment loss calculation is nothing but the carrying value minus recoverable value, and recoverable value is always the higher of assets net selling price or the value in use. Value in use is determined as the present value of discounted net cash flows for the entity. So it is like doing a valuation of that particular CGU. So it is always not necessary to determine both. If you determine one of them and if that value is higher than the carrying value, it is not required to determine the other factor. For example, the carrying value of asset is 100 and the asset's net selling price can be easily determined, let's say which is 120, then you are not required to go and again check the value in this because it is anyways higher on the. We'll take one example before we wind up the session. XYZ has acquired group of subsidiaries A, B, and C few years back. At the end of the current year, there is an indicator that one subsidiary, that entity A, may be impaired. Entity A is a cash generating unit as a whole, and entity A and B falls under one group of CGU. So net assets of the division A and B are given. Goodwill is 80, value in is given 200 and 180. So we need to calculate the impairment loss. Goodwill has been allocated to individual CGU. Allocable goodwill is 40 million. So how do you calculate the impairment loss? You carry out the entity A carrying value 220, allocate the goodwill. So the carrying value along with the goodwill is 260. Value in use is 200, which is given here. So the impairment loss is 60. Okay. So wherever there is a goodwill which is recognized in a business combination or an acquisition, the impairment loss is 60 million in this entity A, whereby it would reduce the net assets and the goodwill to the extent of 200 million. So the impairment loss which is attributable to the goodwill is 40. Entire goodwill will be written off, and the other portion which is 20 million would be allocable to other assets on a pro rata basis if the actual amount is not determined. right? So this is what I wanted to talk about the impairment standard. Any very brief. So we have covered the most relevant questions because of the paucity of time. So we are at the end of this session. I've kept 5-10 minutes for question and answers. So if you have any questions, you can let us know.
Respected members, if you have any question on impairment of assets or any other questions on accounting standards related to income and cost accounting standards, then please let us know. Sir will answer all the questions and queries related to it.
तो संगीत सर चैट में एक क्वेश्चन दिया सर आपको.
Yes, sir. Please go on.
Yeah. Difference between IIR and incremental borrowing rate.
Okay. So basically, IRR is nothing but it is an internal rate of return. So where you take value of the assets and the net cash flows which you are generating. So when you apply a particular rate to the net cash flows which are generated from a particular asset, it will exactly amount to the fair value of that asset. So if you consider the future cash flows of that asset and apply a discount rate to it, it will be exactly same as the fair value of the asset. That is known as an IRR, right? Internal rate of return. And incremental borrowing rate is nothing but if you have to obtain a loan from any financial institution of a value of that particular asset by keeping the security of that particular asset for the similar tenure of that particular loan, what would the bank or any other financial institution charge you as an interest rate? That is called as an incremental borrowing rate.
Dear members, is there any other questions? Sir, I think there are no other questions. And if at all there is any other question, then please do let us know by email or message. Sir will answer the same. So presently we wind up the session, and on behalf of WRC of ICI and being a coordinator of a session, I am thankful to our learned faculty, Sir CA Akshay ji, and for giving a deep understanding on income cost related expenses like impairment of assets and other accounting standards, which will be helpful in our day-to-day auditing also. And this session is much required as the audit season is coming in nearby. So it is much helpful. Sir, it was a wonderful session and your experience has enhanced our knowledge on accounting standard. Thank you very much, sir, being with us. And in future also we will be contact you for the sessions. Sure. Yeah, thank you very much, sir. Thank you, participants, for patiently learning and making a session interactive, asking questions and others. Thank you very much.
Thank you so much everyone for patiently listening to the session. And thank you again WRC for giving me an opportunity to conduct this session. Thank you so much.
Thank you.